And you're listening to Talk Radio 1190. This is the Ask the Experts radio show. I'm John Wolf, and I have a great guest with me. He's been on before, John Harman, a CPA. He's been a Super Saver Award winner, won the Angie's List Award, Best Accountant in McKinney, and numerous other awards. How are you doing today in the middle of tax season, John Harman?
Well, right now I'm surviving. That's all I can say. It's in the middle of tax season is always rough, having time to come up here and speak with you, but I'm happy to be here today. Thank you, John, for inviting me.
Well, very good. And I know the nature of listening to the radio when you're in your car. Just if somebody can't sit in their car, John's phone number is 469-742-0283, 469-742-0283, if you want to reach out to a great tax man to help you out at this time. Do you actually love this time of year, though?
Well, it's hard. I'm used to it. After 28 years of being in the tax profession, you kind of get used of not seeing your family between February 1st and April 15th. And I remember on the way over here today, I remember a letter that my son wrote. He was around 8 years old, and it was around the 1st of February. And he says, Dear Dad, I know it's the start of tax season, and we won't see much of you, but I want you to know we still love you.
Oh.
And I actually still have that letter. And I think about it occasionally when I get really beat down during tax season. And everybody in the tax profession, they work, 12, 14 hours is common in each day.
And you 1099'd him on his allowance, didn't you, at 8 years old?
No, but I want to put some of it in savings.
That's a wise man, a good dad. What kind of new tax strategies are there? We talked a little about that last time, but now we're in the heart of the season.
Mm-hmm. Well, there's been a lot of reports about the new tax law change, and I have a very sophisticated tax program, and it actually allows me to compare 2017 current tax law to 2018. So I'm getting a picture of what's happening to the, your average person who's coming in having their taxes done. And for example, I looked at somebody just the other day, they was making $400,000, and one receiver was going to get maybe a $4,000 or $5,000 tax break next year. And then somebody else, maybe at $250,000, might break even, get a little bit of savings for next year. The big winners are the younger couple who have children, and they're getting a $2,000 child care credit. Their actual taxes are remaining the same from year to year, but because of this credit, they're going to actually get a refund maybe next year. So it's a great deal for parents with one or two kids.
Now, is that just a credit straight out, or is that for if they're paying for child care and such?
No, this is a straight out credit. So there's a lot of benefits in this. Marco Rubio held out his vote for the tax cut till they put this in, and they raised it to $2,000, and that's one of the best features of the new tax program. I can tell you one of the worst features right now, and I'm warning my clients when they come in and they have gambling winnings. Usually you go up to the one of the Indian casinos and you play slot machines, and people go there all the time. They come back with these 1099 Gs where they're reporting the income, their winnings. They might have won $10,000, $15,000, but we always assume they actually lost that amount of money too. They're going up there on a regular basis. That the deck is stacked against you. So if they won $15,000, they usually have losses of $15,000. So it negates itself, and there's no taxes on it. But this coming year, you'll still have to report the winnings, but you don't get to deduct the losses. So one elder couple, they came in here recently. They had almost $200,000 in winnings. They were going up each weekend and gambling, and that was actually using their retirement. And they said, well, we're old. We want to enjoy life. We know we're losing, but we're having a blast doing it. I said, well, okay. And so we, said you had $200,000 in winnings, and so we said, oh, yes, we have receipts. We lost more than $200,000 on this. I said, well, next year you won't be able to report those losses. you'll have to pay tax on the $200,000 of winnings. And I said, in your tax bracket, since it's going to be income, it's going to be 30%. So that winning at $200,000 and losing $200,000 still might cost you somewhere, between $40,000. Mm-hmm. So you end up losing at a casino, then you end up losing with the IRS. It's the worst of both worlds, and I'll try to warn my clients of that when I see those gambling winnings.
What about the stock market? With I think you could deduct up to $3,000 in losses. Mm-hmm. Has that changed at all?
No, that's the capital gains carryover. You can deduct $3,000, and here in the last 5 or 6 years, almost everybody's winning in the stock market, so you don't see it very often. But of course, the stock market never just goes up, mm-hmm. up, and up. It's going to, eventually take a tumble, and then we'll have people recording losses, and it's still going to be limited at $3,000.
Now, I know you're taxed higher on capital gains if you sell within less than 12 months. If you make a profit and you don't hold the stock for 12, how severe is that difference between waiting the 12 months to sell versus making a quick hit and selling?
Yeah, it does make a difference. It could make a difference of, let's say 10% in taxes. And one of the main difference is long-term and short-term. And I always caution people who buy or sell because of tax reasons. I said, you buy when you think the stock has reached its peak. When's the time to buy? Or, when's the time to sell? It's when you're going to make the most money, or you want to limit your losses. Don't worry about the taxes. But then again, if it's coming, you've been holding a stock for 11 and a half months, then you might want to consider tax area and hold it for another 2-3 weeks. But don't let tax actually determine how long you hold a stock. You hold a stock because it's a good investment. Let the taxes fall where they may.
Greed can get in there. I sold some airline stock by accident because I had a trailing sale figure in there, and I really didn't mean to sell it at that time, but I wanted to protect myself because how wild the swings have been almost daily in the last few months. And then I thought, John, you did well percentage-wise. I probably tripled my money on that airline stock, but still that greed gets because now I'm going to have to pay the capital gains on it this year.
Yeah.
So, but it was a profit.
Well, you don't really mind paying tax when you have a profit. I mean,
yes, you do. You still mind. That's why I said the greed. Oh, I should have waited till the last day. I should have known exactly when to buy and exactly when to sell if I were only smart.
I heard this story about Mark Cuban. He made a comment that every time he writes a check to the IRS, the bigger the check, the happier he is because he just made more money.
There you go.
But nobody looks at it that way.
No, not really.
If I had Mark Cuban's money, I might be happy, just period. Yeah.
He's having other problems right now, though, if you follow the news. Now, on the new tax law, what you've seen since you've been into the season now more, what are your feelings? You mentioned about the child tax credit. That's great. But what is your overall feeling about it?
It's my overall feeling about it is basically if you have children, it's really a good benefit for you going to next year, 2018 and 2019. Get a $2,000 credit for a child. I mean, if you have 3 or 4 children, I mean they're expensive.
Oh yes, I know.
And so $2,000 is a really big benefit. And you think about a lot of single moms out there. They're trying to raise their kid. So to me, that's a huge benefit. And outside of that, the tax law is not really a big game changer. However, they did write in a section in there for businesses, and that's where the big savings can come in. Mm-hmm. And I can go ahead and give you a good example of that. I just put the highlights out here. If you're an individual and you own a business, you could be paying 37% taxes. Your tax rate be 37%. Currently this year is 39%, so it lowered it to 37%. If you're a corporation, the maximum you will pay is 21%. So there's a gap of 16% in there. If you're making, let's say, $500,000 in profit, and you're at the top tax rate, and you're going to turn around and save your taxes are 16% lower, that's $80,000 savings. And there's a lot of opportunity out there for setting up a business structure that can save quite a bit of money.
Now, is that just if you incorporate?
It's a little bit more than just incorporating. That's one of the steps. Sometimes it takes 2 or 3 entities to do it. And I'm going to go ahead and go into more detail in a little bit later in the program.
Okay, very good. We're speaking with John Harman of McKinney Tax. His direct information, his most exact information, his phone number is 469-742-0283, 469-742-0283. He is a tax expert. He's won numerous awards. He is in McKinney. John, why don't you give us your website and your email address if you'd like?
Yes. My email is john@mckinneytax.com. My website is McKinneytax.com, www.mckinneytax.com. And if you're up in the McKinney area, type in Best of McKinney, CPA, and I should come right up.
And if you're not even that close, but you might find a way through John to save $8,000, $80,000, whatever, it's worth a drive. It's worth a drive.
Oh, it's definitely worth an email or a phone call.
There you go. And again, you're listening to Ask the Experts radio show. I'm John Wolf, and you're listening to Talk Radio 1190. And you're listening to Talk Radio 1190, the Ask the Experts radio show. I'm John Wolf, and I have John Harman of McKinney Tax with me. And during the break there, we were talking about some of the strategies that you've been able to help people with to save a lot of money on your taxes this year. If you haven't done them yet, you can give John a call, but why don't you tell us about some of them?
Yes, this new tax law changed the game quite a bit for a number of business owners. In the past, it's standard procedure for a CPA will work with small businesses, and the person who might be a doctor or have a small retail business. Say he's making $500,000 a year, and he's a Schedule C, wasn't incorporated, he's not an LLC, and he reported his income on his 1040. Well, out of that $500,000 of income, he'd be paying Social Security tax, FICA, Medicare, and that starts out around 14% for the first $114,000. So it's $14,000 in self-employment tax. There's another 3 to 3.9% on the money after that. So it could add up to a hefty amount. So we're looking at maybe about $24,000 in self-employment tax. And the CPA would normally say, well, we'll set you up with an S corporation, LLC, being taxed as an S corp, and we'll flow your income through this entity. And you end up saving quite a bit of money. There's some caveats to it. You need to set yourself up and pay yourself a reasonable salary. And you're still paying the tax, but you're saving a lot in self-employment tax. And then generally we can save $7,000, $8,000, $9,000 for somebody after it's all said and done. And that's it's almost no-brainer. So sure, I want to maybe set up as a S corp and save that amount of money. It was a run-of-the-mill bread and butter for small CPA firms. We would set up maybe 50, 60, 70 a year. The new clients would come in, and this is one of our ways to help them save money. Now, with the new tax law, it changed everything. Now, so we're working with our current clients, and just ran a proposal by somebody yesterday. They were making $750,000 in their businesses, and we put together a program, and it consisted of 3 different entities, and we're running the money through a partnership, an S corp, and a corporation. And by structuring it this way, we were able to save on $750,000 an additional $63,000 in taxes a year. So we did a proposal, and over a 10-year period, they would end up saving about $677,000 And we've been making these proposals to our current clients, and the tax law's not been out there very long, and we made 14 proposals for our clients, and every one of them's, of course, been positive. I said, who would want to leave $60,000 or $70,000 on the table, or over a 10-year period, $600,000?
And that's if you stuff the money in a mattress, not if you're getting even, let's say, 5-7%, something like that.
Yeah, I mean, you're saving that money. You're going to put it in somewhere, and we're financial advisors. We can help you decide where you're going to put it. You can take the savings and put it in real estate. You can do whatever you want with it. It's your money. We just don't want Uncle Sam to have some of your money. And we have run different scenarios, and it comes down on a question. When we was meeting with a client and showed them a proposal yesterday, and the question is, do you want to save $63,000 next year?
Nah.
And the questions, yeah. I said, I said, what's the secret to this? I mean, what's the secret? I said, first of all, you need to be making $750,000 a year. Mm-hmm. So now it's limiting, limits, the typical W-2 salary. You got to have your business. You got to have a K-1. And the more money you make, the more money you're saving, actually. If you're making $2 million a year, we're going to save you, instead of $65,000, maybe $200,000 a year in taxes. So it's a significant amount of money. And when they wrote the tax law, I'm not sure if they realized the opening, the loophole.
Mm-hmm.
You can drive
I didn't want to use that word. I was thinking of that.
Yeah, you could drive a 18-wheeler through it, and it's out there for people who know how to set up companies and how to structure the business, and you can save on your money. I said the top tax rate's 37%. The corporation tax rate is 21%. So you're saving 16% of your income in taxes. Mm-hmm. So for every $100,000, you're saving at least 16% of it.
Now, a subject we touched on last time, because you're talking about businesses that are successful, for the startup guy, at what point do you say you need an LLC to protect your private savings?
I've been using as a rule of thumb, if you're making $40,000 or more, it makes economic sense. Mm-hmm. There's other times it makes liability sense. If you're in a risky business, for example, if you're doing working with children, or you're developing a product, and there's some liability in there, you could have an upset parent going to sue you, for whatever reason. America is sue happy, and you want to protect yourself and your home and your savings from any liability. You can set up an LLC and have all your business LLC, and they'll have us sell the LLC before they can get to you. So it's good for liability issues, but it's also can save in taxes, and it's around a $30,000 or $40,000 range in the business. If you're just making $10,000 or $20,000, but next year you're going to make 30 or 40. Well, you need to make a decision a year ahead of time. Mm-hmm. For example, I just this morning had an email from a prospect, new client. He says, "I'm selling an apartment complex, and I'm going to be making a lot of money." And he says, "I hear corporations are taxed at 21%. I want to be a corporation." And I was writing back. I said, "Well, you need to be a corporation about 2 years ago."
Oh, really?
Yeah,
okay.
Because that's when he bought the apartment complex.
So you can't grandfather property in?
No, I mean, the corporation can now own an apartment complex before it was born even. Mm-hmm. And so, you have to think about the future on LLCs. And very common use of an LLC now is for real estate. You have renters, and you want to be protected against any accident, where the renter will sue you. And a good example is I have a friend had a rental property, and he was set up as an LLC, and had a renter there for 10 years, and they ended up with a purchased dog. the owner didn't know about the dog. It's in the lease saying not to have a dog, but the dog, they still bought a dog, and the dog jumped a fence and bit a child's ear almost off. Horrible situation. Well, they sued the renter, but they also sued, my friend. But they had to go through the LLC, and he had insurance. And when people are thinking about setting up LLCs, and they want to be protected against lawsuits like this, I always say, your first line of protection is a good umbrella policy. Make sure you have good insurance. And luckily, he had insurance, and I was able to pay off, the claim and all the legal fees. And actually, he didn't have he won the claim. He went to court after 2 years, and he said he spent 4 days in a courtroom, and he said and he was innocent in the whole thing. But having good insurance and having an LLC does protect you.
Now, do people come to you for an LLC, or is it just the same to go online and LegalZoom, or is it really a different animal entirely?
Yeah, we help people set up LLCs, and it's the type of LLC we're set up as a one-man operation, and we can file the documents with the state, get everybody set up, and we're able to determine if you want to be a Schedule C, you want to be a corporation or S Corp, do you want to do payroll, what the rules are. So we offer a lot of consultation involved in that. A lot of times we say, I want to be an S Corp. Well, you need to be an LLC and make election to be an S Corp. You just can't jump in and be an S Corp, S Corporation. So we'll walk them through that process, and you can go out to LegalZoom and you might get the right information, but we spend the time with them, we know what their plans are, and many times, I guess maybe 20, 30% of the time, I'll tell people, you don't really need an LLC yet. Mm-hmm. Make sure you have this nice big idea, but go out there and see if it's going to work before you spend $1,000 setting up an LLC. Now, there's one part of setting up an LLC is if you have partners. Now, a partnership needs an operating agreement, and an operating agreement needs to be drawn up by an attorney. And it's always very important to have that agreement. Matter of fact, I was meeting with a client yesterday, and we was talking about how saving money in our new corporate strategy is a pro-tax strategy. And he remembered back about 5 or 6 years ago when I first met him. He had a partner, and they were fighting each other. And I told him back then, I says, be careful, in partnerships. You got to have it all spelled out. It's like a divorce, and both of you almost need prenups because you're going to split up, and you might as well decide on how it's going to be when you split up when you're both happy. Now, you're trying to decide who gets what when you're both upset at each other. It's a nightmare. And and I told him about a client of mine. They were best of friends. They got upset at each other after 5 years, and they pulled out this operating agreement and said, well, if something ever happened, we're going to do this, this, and this. Spelled it out, and they were getting ready to go to court, and that stopped everything. And he was telling me he just split up. He started a business with a partner a year ago. After 6 months of splitting up, and he said people started getting greedy and want to take, I deserve this, you deserve that. And he got out, he said, here's our operating agreement. The lawyer grew up when we formed a partnership. This is how we're going to split everything up. He says, well, no, we want to do it this way. He says, nope, this is what our agreement said. And he says, that was the best advice you ever gave me.
There you go. Get it in writing ahead of time, and there can be no long-term arguments there, or at least any that carry weight. We've been speaking with John Harman. We could go on about another 8 hours, but they're going to kick us out of the studio. If you'd like some great tax help, go to John at McKinneyTax.com is the email, John at McKinneyTax.com. Again, his name is John Harman, Harman. His phone number, 469-742-0283. And you've been listening to on Talk Radio 1190 to Ask the Experts radio show. I'm John Wolf. Thank you very much, John.
Well, thank you, John.